Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 19th of May, and certainly plenty to get into after a week that has been focused heavily on Donald Trump's escapades around the world. We're going to see a week that by and large doesn't have a huge amount of data out of the US, but nonetheless, there's plenty for us to sink our teeth into with a focus on China, the eurozone, and the UK. As ever, we'll look at the big ticket items first and foremost, and then we'll drill into three different areas of focus. And you can see here, we really kick off the week with that focus on the Chinese region, industrial production, retail sales, the top ticket items, but we have a handful of other items as we will talk about. We've got the RBA interest rate decision. I'm going to provide a separate standalone video for that. Inflation rate coming out of Canada, balance of trade figures out of Japan, then inflation out of the UK. Then we've got the sort of PMI day on Thursday, essentially. So a host of PMI numbers released around the world, inflation coming out of Japan, and then retail sales on Friday from the UK. So let's kick off with a focus on the UK, because starting on Wednesday, we're seeing the inflation report. Then we see the PMIs on Thursday. Then we see the retail sales numbers. So really, we do see a big picture for the UK economy. It comes off the back of the latest announcement that the UK economy grew at 0.7% in the first quarter, beating across monthly, quarterly, and year-on-year metrics against expectations. So suddenly, everyone's starting to think that maybe the UK is in decent shape. Of course, that came in the wake of the fact that the UK was the first to strike a trade deal with the US. So again, a bit of a good news story in the UK. And alongside that, you've got the question marks about whether this actually is a really good environment for the UK to be able to strike those post-Brexit trade deals that it's struggled to do for the most part, because the breakdown in relations between the US and other partners around the world really has forced the hand of other countries to start to look at potentially speeding up those trade deals. The likes of the UK and India, a good example of that. It takes a long time, then suddenly they push it across the line because there's a need to really show that they're making moves to replace some of the demand destruction that comes when you see a ramping up of tariffs from the US. Of course, Donald Trump's pretty much reversed most of those reciprocal tariffs that we saw on that rather ridiculous board. 10% still looks like it's going to remain in place, but given the fact that many of the producers, the exporters, are going to be sort of taking a little bit of a margin cut on that, and it looks like some of it's going to be passed on to US consumers. By and large, that 10%, it's not necessarily the end of the world. So this week will give us a good idea of the direction of travel for the UK economy. Inflation, key to that. So we've got the expectation that we see a sharp jump in terms of the headline inflation figure. This is up to 3.3%. That is substantial, but that's not necessarily going to be a case of actually that there's been a massive bump in inflation on a monthly metric. That will be base effects if that's what does come to pass. Bear in mind, I'm recording this on Thursday, so you want to look at these data points a lot closer to the time when you see those initial data estimates coming out. Generally, they will become more accurate over time because there's more predictions that actually go into it. So sometimes, we might talk on one of these videos about a data point that could be coming out, and I'm saying, it's really surprising that it looks like it's going to see some X happen, right? And then when it comes down to it, you look at the economic calendar maybe the day before the event, and it's completely different. So be aware of that. Some of these numbers are going to change. Other parts of this calendar will be updated as we go forward into Friday and into Monday as well. But nonetheless, the theme here is around the potential for economic strength, talking about the potential pathway for interest rates in the UK, of course, the stronger than expected GDP number, if that's built on with high inflation, with high PMI numbers. And of course, that's the kind of thing that could strengthen the pound, in part down to the idea that we're going to see a stronger UK economy, also in part on the idea that maybe it says to the Bank of England they can take their time when it comes to being supportive, in particular if we saw a resurgence in terms of inflation pressures. So in terms of US and UK inflation, you can see here that core inflation at 3.4%, the headline figure at 2.6%. What's notable here is that we've got the core figure where we're expecting to see some really significant downside coming into play. By and large, we haven't necessarily got that figure here in terms of the year-on-year core figure. So 3.4% is the last number. But you can see here, so 0.4 is what expected, but you look back at last year, it's like 0.9 or 1% in that month of April alone for the core figure. So we can see that in the middle section on the left, the big orange bar for April. That gets stripped out and the so-called base effects kick in, right? So if you have a 12-month metric, you lose April from last year and you replace it with a new April, and the new April is significantly lower than last April. That's when you see significant bumps in terms of, or moves in terms of the year-on-year metrics. And that's what appears to be the most likely thing that's going to be happening here. So 0.9 or 1% from last year, dropping out, 0.4 coming in, which is what markets are expecting. Of course, we don't necessarily know that's what will happen. But if that was to happen, then just crudely, you're talking about the potential for 0.5% to be wiped off it. That means that core could potentially move down to 3% or below 3% in this report. That could grab the headlines. Now, we're talking also about the idea that, you're going to see, so 3.3 in terms of the headline inflation from 2.6. Now, if we just roughly look at that, you can see that the April headline figure was somewhere around 0.3, 0.4 last time around. For it to get all the way up to 3.3, we're going to have to see a significant jump here. So it's not like the base effects are going to come in here. So I'm expecting those forecasts to be pretty different when it comes to Friday or Monday. I think they'll likely move in terms of that 3.3 figure. But instead, I think there's more likely to see a narrative around disinflation, in particular in that core metric. Now, I've done it says 8-month annualized. I'm pretty sure I changed that to 9-month annualized. So like within the next 3 readings, where are we going to be? And that takes us down to headline 2.4, core 2.3. So in actual fact, if you look at the sort of core metrics, the headline core number, the year-on-year core number is at 3.4%, right? So it looks troubling. At the same time, if you look at those bars in the middle, right, these sort of orange bars, really you've got a lot of figures that are below the 0.2 mark. So it has been tracking at a relatively low level. It's just that we've got this massive figure from last April that's getting stripped out. So we could see some quite significant disinflation coming into play this time around. Nonetheless, like I said, we're seeing that stronger GDP number coming into play. We're seeing the PMI numbers in focus here. So manufacturing expected to improve, services expected to improve, composite also expected to turn higher, bearing in mind they're all in contraction territory at the moment. But I do think that sort of blip around the sort of tariffs and everything like that is likely to start to reverse now that we've seen some of these announcements. Now, in terms of the chart to watch out for this time around, I think a really interesting one here is the pound against the New Zealand dollar. Now, just go full screen. So first and foremost, it's worthwhile bearing in mind that the New Zealand dollar and the Kiwi dollar have both been doing really well of late. And you can see that with the fact that we've been seeing this significant downside over the course of the last month and a bit in terms of the pound against the New Zealand dollar. Part of that is going to come down to the idea that these two economies that are heavily geared towards China have now got a new lease of life, essentially, with the fact that the US and China are striking these trade deals. But this looks to have turned, right? So the reason I'm jumping on this is I knew I wanted to chart something against the pound. I looked at across the board of the major crosses for the pound against other currencies and wanted to find the most reliable trend. And this is the one that I found, right? So you've seen this consolidation, and then we've been breaking. We've got this uptrend that's been playing out since these lows in 2022. Now, what's particularly interesting about it here is that this recent recovery looks to be forming a double bottom formation. If we're looking at the bottom end of this trend, we can sort of try to pick a number of these lows. Let's try and sort of grab. So we've got 1, 2, sort of run through there, 3, 4, and then now 5, 6. So that definitely looks like the kind of area where we could bottom out here for the pound against the New Zealand dollar. Then we're looking at it as a retracement. So where do you draw your fib from? So you have trends within trends within trends, right? So different time frames tell you different things. This monthly time frame, you're not going to look at that fib on it. This is the 30-minute time frame. So you really have to try and gauge exactly what trend you're trying to trade here. This is the daily time frame, which I think is particularly interesting here. So we want to take it from that swing low before you see that next multi sort of stage leg higher up to the top, extend it out. So we could probably just draw it out here. Doesn't need to be absolutely perfect. So you can see we've come into that deep retracement zone between the 61.8 and the 76.4 fib. That's the exact area where I like to see these moves come into. Then you want to see essentially confirmation that this is the low. Now, how would we see such confirmation? The confirmation would come with a breakout from this near-term sell-off by essentially creating higher highs. Now, key to that is we've also created a higher low. So this will give us a double bottom formation, fortunately with a higher low within that. And therefore you'd need to see the higher high coming into play. That's exactly what we've seen here just today on the Thursday with a rally through 226164, right? So we've broken through resistance, number of different ways to play it. Essentially, you're looking at this as a double bottom formation. That means some people will be looking to utilize sort of measured moves. So you'll be looking at the height of this double bottom, which is sort of 0.0483. So 0.0483. Let's try and get it so I can actually see the thing. So that would take us up to here. So that would look like a potential projected move higher. You know, at the same time, you very clearly have an uptrend in place. So there's a possibility of a rally back up into your 2.33 level. In terms of, you know, if we're looking at areas where people might utilize the stop losses, you know, what would need to happen to negate the idea that this is bullish? Well, because you've got that daily time frame, you can utilize the lows of that double bottom formation, but I can also see that within this rally, we've now got this creation of sort of higher highs and higher lows. So the 4-hour chart highlights that. So we're now potentially in a new bullish trend. So essentially, you're looking here at the potential for a sort of swing low here to come into play, 0.03 essentially, and then a move back up to the top here, 0.07. So, you know, if that was a trade, given the breakthrough, that's a double bottom formation, you're looking at more than a 2-to-1 for a move up to the high versus a breakthrough this recent swing low. But essentially, in my mind, look, I think it looks bullish given the wider trend that's in play. If we see a breakdown through the double bottom low in particular, that would also be the thing that would negate that wider trend line support as well. So that would be the thing that starts making me think maybe the idea of that this is bottoming out and going to rally is wrong. And so essentially, you know, sometimes when you try to be too crafty and get too close to your stop loss and utilize nearer swing lows, you have to bear in mind what would negate the idea that this is a low, and a break back down to here into sort of trendline support once again, that wouldn't do that. So in either way, I think this is a really interesting chart to be following over the course of the coming weeks. Next up, let's look at the China region. So China, of course, has been in the news massively. We've seen huge volatility in terms of Chinese equity markets. Of course, we saw Donald Trump coming into power. People worried that there was going to be a sort of massive breakdown in relations between the US and China. And we saw the DeepSeek news. Suddenly people started thinking quite positively about China. It looked like Donald Trump was quite soft on China in the first place when it came to tariffs. He kept talking about how awful the EU was and the eurozone, not necessarily talking about China. Then he just kept targeting China. And so Chinese stocks were getting hit hard when he ramped up. You know, he essentially took off the reciprocal tariffs. Apart from China, Chinese stocks under pressure. Now we've seen them removed essentially apart from 30%. So, you know, they give and take and give and take. What's key to this is that the Chinese are very aware of the fact that, number one, they have to gain stronger partnerships around the world aside from the US. Number two, they have to stimulate more than ever. You know, they can't just sit on their hands as they have done over recent years. And then on top of that, you know, there is the potential for the US-China relationship to still be relatively strong. But this release will be interesting because you're seeing April data for house price index, industrial production, retail sales, fixed asset investment, and unemployment. Then you're seeing the loan prime rate for the 1 year and the 5 year on Tuesday. So key to this essentially is like, how is the data shaping up when people are faced with these massive tariffs? Now, the caveat here, of course, is the fact that the tariffs have, by and large, the vast majority of it being wiped off for 90 days, right? But it does highlight the risk posed by these tariffs if they're re-implemented in 3 months' time, right? So it's going to be really interesting. So the forecast here is a sharp decline in terms of industrial production growth. So not a decline, it's still pretty healthy at 6.2. Retail sales expected to slow as well. Fixed asset investment expected to actually be better. Unemployment rate steady. House prices easing a little bit, actually. A slight improvement despite not necessarily looking great. But ultimately, this is talking about the resilience of the Chinese economy in the face of those tariffs. Now, I've got the retail sales and industrial production charted here, and it sort of shows that actually it looked like it bottomed out, the Chinese economy, and starting to improve some. So if you take away the US tariff threat and you say that's improving, and then you look at the potential implications of stimulus measures from the likes of the PBOC and the like, and you see the sort of general direction of travel, things are gradually improving in that region. And we have seen the likes of the Hang Seng or Chinese and Hong Kong stocks sort of oversold. So I think it's a really interesting area to be looking into, essentially. Let's look in terms of the Hang Seng and pick through it. It's something that we have covered relatively recently, because I think it's a really, really interesting market to be looking out for. Now, it was a few weeks ago that we were talking about it, and we'd seen that pullback. I think we were around here, and I was talking about it looking bullish and looking like it's just set to provide another leg higher within this trend. That's exactly what has been happening here. So the bullish trend is playing out. You would see that initial sort of pop and then some of these strong candles, and now starting to turn into smaller candles, but nonetheless bullish in their nature. Now, the risk here, of course, is that the rally is starting to fade, and some of the optimism that we have been seeing is sort of waning a little bit. The easy way to show you that is to show you the NASDAQ. Let's just show you that. So they don't necessarily always line up together, but recently they have. So as you can see here, Chinese markets going hand in hand with the NASDAQ, both regaining massively over the course of the past sort of 6 weeks. But the question mark here is, does it have legs? Potentially we could come into a retracement phase. I would say look out for the ability to continue to create these higher highs, higher lows. Let's just see exactly where we sort of want to look in terms of time frames. I guess 4 hour will just about do it. Let's just see exactly where some of these lows will take us. If we take in the absolute lows, not perfect. If we're taking sort of something more recent, let's see how that's sort of treating us. So yeah, that's quite decent. I think it's interesting that what we're seeing at the moment is a slowdown in terms of the gaps between the swing highs. So you can see that gap up to that gap. So each time we break through resistance, seeing a nice bump. It's almost like for like. You can see there's a relative symmetry in terms of like the pullback size and the rally into the next move and consolidation and pullback. Rally into the next move, consolidation, pullback. Rally into the next move here. We pulled back, we rallied, we found resistance, and now starting to roll over again. So there's question marks sort of coming into play here. I guess the question mark also is this a retracement of the big move? So let's look at the fib, and you can see that we're around that 76.4 fib level. I don't necessarily think that we're going to roll over to the extent of like we're going to break all the way back down towards here. But I do think that there are risks over the near term, just given the sheer size of that move towards the upside. So certainly if we were to start breaking down through your 23020, then that points towards a possibility that we start to see a sort of a pullback. Maybe let's go on to the 4 hour chart, maybe sort of a wider pullback into this kind of area, sort of 224 kind of area, something like that. But yeah, I would just say sort of be a little bit wary at the moment. You know, if we were looking at this as a retracement within this bullish trend, which as it stands, that is strictly what it looks like, you can see that we're actually tagging the 76.4 fib perfectly and starting to rise once again. So the bull trend isn't necessarily over, despite the fact that we're sort of not floundering, but just losing a little bit of the momentum that we have been seeing recently in terms of the likes of the Nasdaq, in terms of the likes of the Hang Seng. But we've pulled into the 76.4 fib at the moment, respecting it. And that sort of bullish recovery phase does still remain in play unless we see that 23020 level broken. And finally, let's just jump back onto this and we can focus on the eurozone. The eurozone, of course, a really interesting story because by and large, recent years have all been about how awful things are in mainland Europe. Germany in particular suffering. This big story about how, like, you know, cars used to be all about German manufacturing. Now it's the likes of Tesla and Chinese EV makers that are dominating, and all of these sort of classic names, traditional names in cars and automotives in Germany and within Europe are sort of falling behind when it comes to EVs. Nonetheless, of course, with the breakdown in relations between the US and the Eurozone and Europe, you're seeing Germany ramping up spending. You're seeing infrastructure and defense spending on both the German level and the regional level are ramping up. And so people are starting to think, well, look, we thought there was going to be a breakdown in relations between the US and the Eurozone. They've now cut those reciprocal tariffs. So we've got a reprieve for now. And at the same time, we're seeing a ramping up in domestic spending and a focus on domestic spending. So there's sort of dual forces coming into play. We've seen Merz now confirm that he's succeeded to become the new chancellor. So things really getting going, and certainly the DAX has been doing very well within that, of course, hitting record highs. And this week we're going to see some key data points coming out. So Tuesday, consumer confidence. There's an expectation that we see that regaining a little bit ground, not necessarily looking great. We've got minutes from the ECB, but non-monetary policy meeting minutes. So that's not minutes, that's a meeting in itself. But key to it will be Thursday, because the PMI numbers are essentially one of the key leading indicators as to what we're seeing within the economy at any point in time. And as you can see here, we're seeing an expectation of improvement across the board for the French numbers, improvement in terms of manufacturing in Germany, a tick lower in terms of the composite German number, but improvement in terms of services. This, again, I think is an example of sort of initial forecasts that are probably not necessarily going to be that accurate, because a decline in terms of the composite reading, but improvement on both services and manufacturing doesn't make much sense unless there's a massive collapse in the construction sector. Then looking at the Eurozone, you can see flat on composite expected, improvement on manufacturing, improvement on services. So again, I'd probably expect to see the composite number improving within all of this as well. But so essentially you're seeing a story about improving conditions within manufacturing and services across the Eurozone as a whole and across the likes of Germany and France, some of the biggest economies within the region. So good news stories coming into play. The IFO business climate number expected to drop, the current conditions expected to improve, the expectations expected to decline. So a bit of a mixed bag there. But crucially, you know, we're talking about this as a leading indicator. Well, you can see why, because these are all May figures. They're all up-to-date figures, and they're not last month. We're not talking about, oh, we've seen Q1 GDP, or we're not saying, oh, we've seen a March reading or an April reading. We're in the middle of it, and we're getting up-to-date data over how the purchasing managers perceive conditions right now. And so let's round things off with a look at the DAX. Here we go. Like I said, from a long-term perspective, it's been doing very well. You can see years of consolidation in the past, but more recently seeing really rampant gains. That sort of sell-off that we saw around Liberation Day recovered and some, and you can see now the trend very much back in play. So if we're looking at near-term sort of support, you know, I guess you could say that we've potentially broken through that here. I would say this is a more notable swing low. Let's get onto the 4-hour chart. So we've sort of tagged that support level and started to rise once again. If we break the 22855, then yeah, it looks like we're going to give back some of those gains. But at the moment, the bulls are coming back into play. I would say the sort of dual benefit of like the upside expected from domestic consumption and the fact that the US and the Eurozone at the moment have seen a cooling in terms of tensions and this idea that they're going to have a tit-for-tat trade war, which certainly will benefit the Eurozone. That's cooling. there's a number of factors going into it right now, and things are looking good. And the ECB, meanwhile, are still happy to and able to continue cutting interest rates to provide a boost as well. So a number of things over in the US, whether it comes to interest rates and relationships around the world and things like that, you still have some question marks, inflation and like. But the eurozone doesn't necessarily have that. Of course, the US also question marks around the ability to spend what they want. So yeah, the DAX remains an interesting one. It remains within a bullish market in my mind. And so I continue to think that this looks attractive unless we break through that 22855 support level.